Alright investors, today let's talk about Venture Global, one of the largest LNG exporters in the United States. Founded in 2013 and based in Virginia, the company operates the Calcasieu Pass and the Plaquemines LNG export facilities in Louisiana, and it has a market cap of around $36.9 billion, and with a P/E ratio of only 15.7, it looks relatively cheap compared with many other LNG names. The Q1 2026 results released on May 12th were explosive. The revenue came in at $4.6 billion, up 59% year on year, while the EPS was 19 cents, beating the expectations by 5 cents. And the adjusted EBITDA reached $1.4 billion with a margin around 30%. But the real muscle catalyst was the guidance. Management raised the full year EBITDA guidance from $5.2 to $5.8 billion, all the way up to $8.2 to $8.5 billion. Almost a full step change higher. The Q1 exports hit a record 130 cargoes. 2026 contract coverage jumped from 69% to 84%, and the company signed a multi-long-term deals with Trafigura, Vitol, Hanwha, and Total. Even more importantly, the Strait of Hormuz is shut and Middle East LNG supply remains offline, with Qatar's 13 million tons of capacity potentially disrupted for years. The current TTF and JKM forward curve inversion may not be sustainable. Winter prices could be forced higher. So my conclusion is simple. The full year EBITDA guidance nearly doubling, Middle East capacity disruption, and the potential of winter LNG price upside creates a triple catalyst setup, and with the trend pointing higher. And the current level can be used for slow stage deployment. I would place the stop loss below 11.5, and if the stock breaks above $15, the first target zone is $17 to $18. But if it breaks below $11.5, I would step aside and stay on watch. One major red flag is insiders have sold 28 times over the past 6 months with zero buys. So yes, LNG alpha story looks strong, but this is not a blind YOLO trade. Position sizing and risk control are the key.